Hello, my name is Chuma Daniel, and you're welcome to my YouTube page. Now, for those of you that have constantly been seeing all the things, all the value that will be sharing on this page, now I want to congratulate you because somewhere around this video, you will have a chance to have an offer, a package right from the family. So make sure you see this video till the end and get this particular offer that myself and the family is bringing to you. System of trading in the financial market that has to do with a simple yes or no answer. Binary options trading is one of the ways to trade financial instruments. A trader needs to watch the chart of the asset's price and predict whether the price will move up or it will move down by the end of a certain period of time. Each time the trader clicks call, the price will increase, or if the trader clicks put, the price will fall. You are making a deal. If your prediction is correct, you will get your investment back and up to 90% of profitability. In case your prediction is wrong or incorrect, you will lose the sum invested in the deal. Now, what are the key features of binary options trading? The first thing I want to talk about is the expiration time, which is the expiry time. This is the period between buying the option contract to the time it finally closes. The period can vary from 1 minute to a month, but most traders usually option for short-term options that last from 60 seconds to 30 minutes. Another key features in the binary options trading is strike price. This simply means the price at which a call or a put option can be exercised. For example, the current price of gold can be $1,500 and the winning trade gets 80% return. You place an up bid expecting price to go up, let's say with $100. When the contract does closes and the gold price goes up, you get back your $100 plus 80% of your initial money you invested, which is the amount you placed for that deal. In this case, you will have $180 at the end of this transaction. In case your prediction was not correct, you would lose just $100 you have put in that particular option. And that is why it is called options trading. Now, the last feature I want to talk about in the binary options trading is the payout offer. A payout is a return, usually in percentage, that the brokers offers to traders. In the gold example that we give in the previous slide, the offer is 80% for a successful trade. The maximum potential loss is limited to the amount invested in that option. However, some traders can give an offer up to 10% of a loss. As a trader, you will know this percentage before placing your bid. The third and the final key features of the binary options trading is the payout offer. A payout offer is a return, usually in percentage, that the brokers offer to traders. In the gold examples in the previous slide, the offer is 80% of a successful trade. The maximum potential loss is limited to the amount you invested in any option. However, some traders can give an offer of up to 10% for a loss. As a trader, you will know this percentage before placing your bid. Just like in the picture right here, as you can see, we have various assets on the left hand side where we have percentage which the broker is paying out in front of them. As you can see, EURCAD is currently paying out at the time of this screenshot 60%. So as you can see, CAD is paying out 84%. So that means any amount of money you invest, you get 84% back if you win that particular transaction. Just like it is stated here, the amount we are investing on this transaction is $30, and it's also giving us the 84% in values of the dollar, which is now 25.20 USD. So before you go into any transaction, most brokers interface will tell you how much money you tend to make before you go into any transaction. What are the trading strategies that you can use to make money off this type of trading system? With the binary options, your risk is limited to traded amount, which can be as little as $1. When you lose, the traded value is lost, or a percentage of it is depending on the broker's offer. That's any broker you use determine how their system really works. So before trading, invest ample time in understanding the risks and always use price action in making sound decisions. Technical analysis indicators are also popular amongst traders. Now, how does the binary options interface really work? There are various brokers and and every broker interface is a little bit different. But some of the most popular interface that we really use is going to look like this. Okay, now on the left hand panel we have various currency that you can invest or you can trade on. We have the USD JPY, we have the USD CHF, USD CAD, GBP USD, GBP AUD. All these are assets that are valuable to trade at this time. Now, in front of those assets, as you can see, there are various amounts or percentage that the brokers are willing to pay you if you want to trade on these particular assets, which is these currencies. Okay, now the percentage in front of all these various assets are what you're going to get if your prediction is right on any transactions that you go in. Now, the middle of the screen is where we have our chart. This is where you can be able to look at where market or the price is definitely has been reacting for a while. Okay, now the orange line you see here, the orange line you see has to do with the current exchange rate or the current price of the particular pair that you have selected. Now, on my screen right now, we have the Euro USD selected, and it is right here. The Euro USD is paying out 75%. So on my screen, which is the center of the screen, this is the reaction for the Euro USD on chart. This is how the price has been moving for the last few minutes. Okay, and the current price when this exchange rate was taken, it's currently 1.13740. That was the exchange rate or the price of the time that this particular transaction was taken. Okay, now that being said, on the right hand panel we have where your balance is going to be. Like, there's no money in this particular account, so this is the place you see your available balance, and after the available balance they are going to ask you what type of options trading do you want to take. Most traders do take up turbo trade, so they do not want to take intraday trading, so they always work with turbo trade. When you are using turbo trade, you can only invest or you can only use between 1 to 30 minutes of your time. So most traders like trading in between 1 to 30 minutes. So the time column is where you select the amount of time you want to give for any transaction. Let's say you want to take a 1 minute transaction. The next phase is, do you want a fixed time on or off? If you click on this fixed time button, this particular time which is close to this particular time which is on the chart will stop, because right now it is on a timer mode. It counts down. Okay, it counts down to 50% of the time and it restarts. But when you click on fixed time, any transaction you take is going to be exact 1 minute. Okay, this varies depending on the broker. Okay, now the amount section is where you place the amount of money you really want to risk or you are intending or putting on any deal. Okay, now for example, we want to use $10 and the profit is already showing us that if we invest $10 for this deal, we would make 75%, which is $7.5. Okay, does that make sense? Now the green button is where you click when you expect price to go up, and the red button is what you click when you expect price to go down. Okay, now in between the red and the green button we have the current price. So this price and what you see on your chart is the same always. Okay, this is how most of the brokers platforms really work. In the advanced session, we're going to talk about how to use some of all these brokers. Just stay with us. Now, what are the most traded assets that we have in binary forex? We have 8 major currencies that we trade. They are as follows: the dollar, the euro, the pound, the yen, the Swiss francs, Australian dollar, and the Canadian dollars. These are the currencies that are mostly traded in the forex and also in the binary forex market. So these are the major currencies we have in the market. Now, because we know that these currencies are being traded in pairs. The major currency pairs that you're going to be seeing, the most traded pairs, which are the majors, which is any pair that has the US dollar in it, is considered as a major. As a beginner, you want to start with trading the majors. Okay, these particular pairs that are in front of you are considered as the major currency pairs that you can trade on in the financial market. So any pair that has the US dollar in it is considered as a major. Okay, now apart from real trading majors, there are also cross pairs. Now cross pairs are pairs that are pairs that contain either one of the major pair against one of the like any pair that doesn't have the US dollar in it. So it's a pair between one major currency against another. This is also considered as a cross pair. And these are the examples of cross pairs we have. We have the cross, Euro cross, we have the Japanese cross, we have the pound cross, we have the Canadian cross, Australian cross, and the New Zealand cross. Okay, now understanding how the currency pair really works. First of all, the forex markets are always quoted in pairs. Okay, now the price for a pair is how much of the quote currency it costs to buy 1 unit of the base currency. Now, looking at this picture, the GBP US dollar, the GBP is the base currency, while the US dollar is the quote currency. Now, any pair you see, the second pair or the second currency is always the quote currency. So the price that you see in front of it, it's simply like when you see GBP US dollar, what this means is that 1 pound is worth 1.32 US dollars. So the price of a pair is how much of the quote currency it costs to buy 1 unit of the base currency. When you trade Forex, you are always buying one currency while selling another. Please always have this in mind. When you are trading in the financial market, you are always buying one and selling another. If you are putting in a sell order, you are buying this quote currency and you are selling the base currency. If you are if you are putting a call order, which is a buy order, you are buying the base currency and you are selling the quote. Okay, always have that in mind. Okay, what are the trading strategies that we have in binary forex? There are different strategies you can apply, and your choice depends on the situation you have. Also take the time to understand the candles chart pattern to help you in judging the state of the market prices and the direction they are likely to take. Now, you should also take out time to understand the anatomy of the candle. How does the candles really look like? Now, we consider this green candle as a bullish candle. Now, what do I mean by bullish? Which is a candle that is going up. Is also considered as bullish. Okay, now for a buy candle or a bullish candle, the candle always opens up at the bottom, as you can see right here. Now, when price moves up, it will close at the high price, okay, because it is going up. As you can see, price opened up at the bottom and it closes at the top, which makes it considered as a bullish candle. Now, every regular candle has wicks. These little lines you see at top of the candle or below the candle is considered as wick. So when price goes lower and still comes up, it is considered as the low. So despite the fact that price actually closed at the high price, it also went low. So the lowest price got to is considered as the low of the candle, and the highest price it got to is considered as the high. Okay, now the middle of the candle is considered as the body of the candle. Now the reverse is the case for a sell candle or a bearish candle. The bearish candle opens up at the top and it closes at the bottom. So it also has high points and low points. Okay, now just to make you understand, there are some candles that looks like this. You're going to be seeing all these type of candles in the chart, and these candles are considered as change in momentum candle. They sell a story to you. Every candle tells you something. So these candles are considered as change in momentum candles. While this type of candles that looks like cross is considered as indecisive candles. Okay, that being said, let's move over to the next slide. In this particular market, we are going to in this particular training, we are going to be talking about how to identify the direction of the market. In order for you to know or identify the direction of the market, you need to use what we call trend lines. Okay, trend lines are probably the most common form of technical analysis in forex trading. They are probably one of the most underutilized ones as well. Okay, most people really don't use trend lines, but they are very, very important. If drawn correctly, they can be as accurate as any other method when it comes to trading. So there are three major types of market trends, which are the uptrend, the downtrend, and the sideways trend. So looking at the picture above, you can see that the trend lines are used to identify all these moves. The blue lines are for the uptrend, and the red lines, we use it to identify the downtrends. Okay, all these lines are lines that you would draw to be able to know the direction of the market. Okay, in the advanced session, we are going to be taking it deeper on how to draw trend lines and structures, market structures. Okay. Now, what are the ways to analyze the financial market? There are various types of analyzing the forex market. Now, the first one we want to talk about is the technical analysis. Technical analysis is the frame in which forex traders study price movement. The theory is that a person can look at historical price movements and determine the current trading conditions and potential price movement. Technical analysts use charts because they are the easiest way to utilize or visualize historical data. You can look at past data to help you spot trends and patterns which could help you find some great trading opportunities. More also, with all the traders who rely on technical analysis out there, these price patterns and indicators signals tends to become self-fulfilling. Another way to analyze the forex market is the fundamental analysis. The fundamental analysis is a way of looking at the forex market by analyzing economic, social, and political forces that may affect the supply and demand of assets. If you think about it, this makes a whole lot of sense. Just like in Economics 101 class, it is supply and demand that determines prices, or in our case, the currency exchange rate. Using supply and demand as indicator of where price could be headed is easy. The hard part is analyzing all the factors that affect supply and demand. You have to understand the reason of why and how certain events like the increase in the unemployment rate affects countries' economy and also monetary policy, which ultimately affects the level of demand for its currency. The idea behind this type of analysis is that if a country's current or future economic outlook is good, their currency should strengthen. The better shape a country's economy is, the more foreign business and investors will invest in that country. This results in the need of purchase of that country's currency to obtain those assets. That is how the fundamental analysis works. We would go deeper in the fundamental analysis and how to trade using fundamentals in the advanced session. Another way to analyze the market is the sentimental analysis. Earlier, we said that price action should theoretically reflect all available market information. Unfortunately for us forex traders, it isn't that simple. Why sentimental analysis is important? Each trader has his or her own opinion of why the market is acting the way it does and whether to trade in the same direction of the market or against it. The market is just like Facebook. It is a complex network made of individuals who want to spam our news feeds. Each trader's thoughts and opinions, which are expressed through whether positions they are taking or helps form the overall sentiment or market regardless of what information is out there. What I mean by this statement is simple. Every trader's sentiment influences the direction of the market. It influences what way or what direction the market tends to go. Okay, the problem is that as retail traders, no matter how strongly you feel about a certain trade, you can't move the forex market in your favor. As a trader, you have to take all this into consideration. You need to perform sentimental analysis. It's up to you to gauge how the market is feeling, whether it's bullish or bearish. Then you have to decide how you want to incorporate your perception of the market sentiment into your trading strategy. How do we trade using technical analysis? Now, when you want to start trading using the technical analysis, you want to start with, first of all, understanding how the market works. The first thing I want to talk about is the currency strength meter. Whenever you see the data that are produced from the currency strength meter, it can give you a sense of what direction the price is going to go to, because this particular market is like a tug of war where price is trying to drag the base currency is trying to drag the quote to its way, or the quote currency is trying to drag the base currency to its way. So now, when you see multiple bars, using livecharts.uk.za to identify this particular price movement, when you see multiple bars on a particular currency, what it means is that particular currency has strength. But when you see less bars on a particular currency, it means that currency is currently weak at that particular time. So the idea is that when you put these currencies on a balance scale, the stronger currency tends to pull the other currency, which is the quote currency, to its way. So if the euro or the pound is stronger, it's going to drag the US dollar to its direction, making the exchange rate to go up. Because when you put the pound here and you put the dollar here, if the base currency is stronger, the price tends to move up. That's how it is. So another way that you can be able to trade using technical analysis, what we call price action. Price action is the study of what has happened in the past, because it tends to repeat itself. So collecting multiple data from the past to predict what is going to happen in the future is what we consider as price action. One of the things you have to look out for while using price action is candle patterns, support resistance zones, channels, and also pullback. These are the things you consider when you are talking about price action. Of course, we're going to go in depth of all these trainings, all this price action training in the advanced session. Now, another way of trading using technical analysis is market trends. Now, when market is moving up, it's going to start from a low point, and that point where it starts from is considered as a support. So when price moves from a low point to a high point, it will come back down. Just like the law of gravity, whatever goes up must surely come down. So when price comes down and it fails to come back to the previous low, we start having the feeling that, there is a tendency of this price moving higher than the previous high. So when price goes higher than the previous high, it's going to form a new high, which is now higher than the previous high, which is also considered as a resistance. So when it forms a higher resistance, we have the momentum, we have started building momentum that price is going up. So when price is coming back to an area of resistance or area of support, the movement between that high and that support area is what we consider as the pullback. So when price pulled back, it's not definitely going to come back to the lowest support, or it's not going to come back to the support area. But most times it can do it, but it will definitely respect the previous resistance. So when it comes back to that area of resistance, it's going to make use of that area of resistance as new support. That doesn't mean the previous support is not valid, but the idea is, if you want to trade using this trend, you look out for trades on anything higher than the previous low. Okay, because price, you can go in for a buy or a call whenever price hits a support area, but most cases, because of price actions, price tends to use a previous resistance as a new support, as in this case. So when it comes back to a previous resistance, that is a valid area to take your buy trades. Okay, so now when price goes up and it removes that previous high, it's going to form a new resistance or a new high, which is higher than the previous high or higher than the previous resistance. The idea is, until price comes back down, until price does a pullback, do not go in for a trade. Always wait for the pullback before you go in. Okay, for this case, price pulled back down, but it broke the previous resistance. So the technical traders might see this particular move from this resistance down as a possible move or a possible reaction for a sell, but you have to wait. So when price came back to this previous support, it starts giving us signs that it's going to go up. So you take another entry on the area of support, and price moved up. So until price removes this resistance, which is the new resistance, it's also considered as a potential down move, because it has cancelled, it has failed to form new high. But as long as price is forming new high, you can call that an uptrend, okay, or an upward momentum. So now look at when price started failing to give us new highs. This is what happened. Price broke this high, gave us a new high right here. It came back down, and it came back to this previous high, making it a new resistance, a new support. So when price hits that level, it went up. So when price went up, we expected that, oh, price is going to form a new resistance higher than the previous one, which is this current one. But look at what price did. Price failed to remove that resistance. So as long as price failed to remove that resistance, we consider it as a lower high. So whenever price starts giving you from a high point to a low point, and it starts gives you lower high consistently, is considered as a downward momentum. So when price does all these things, price has given you a sign that it's moving to the downside. So when price is moving downwards, you take your sell or put entries at lower highs. So the ultimate rule of trading using market trend, if price is trending upward, is you take your entries, which is your buy entries, at higher low or higher support. But when price is coming downward, you take your sell at lower resistance or lower highs. Every lower high or lower resistance is a potential trade entry area. That being said, let's move over to the next slide. Now, when price is going sideways, you want to look for buy whenever price comes to the floor or the support areas, because looking at this particular picture, price is not going up, it's not coming down. So anytime price starts, anywhere price hits and it starts dropping, it is considered as a resistance, and whenever it hits an area and it starts going up, it's considered as a support. So when price is going sideways, you can take sell and buy orders, because price will just be going up and it will coming down. So whenever it makes a support, you take a buy. Whenever it makes its resistance, you take a sell. Okay, this is how you can trade using this part of technical analysis, which is the ranging market. Now, technical traders also use candle confirmations before they buy or they sell. Now, for a buy scenario, they also use the area of, okay, because I told you in the anatomy of a candle, you can go back to the previous video or just rewind back and watch it when I talk about the change in momentum candles. As you can see, price moved from a low point up and it started coming back down, this is considered as a pullback. So when price come back to the area of support, it gave us a confirmation candle, which is a rejection on an area we were looking at entering. Okay, so when price gave us a rejection at around this area of support or area of resistance, which is now new support, we waited for the market to close. So when price closed above, as you can see, it is a rejection. This wick right here is considered as the rejection. There was no wick at the top, but there was wick at the bottom. So now, what do? You enter at the open of the next candle. So not just looking at it, okay, when price comes back, we enter at higher support. So when a price comes to higher support, you have to look at the candle. What type of candle are you seeing? Did the candle give you this rejection? You don't want to see something like this. You want to see this. It's very important. You want to see this. So when price gave us rejection, we waited for the market to close and we entered at the open of the new candle. So price came down, but we'll look at watch what happened. In 3 candles, price went up. So when you go in on a transaction, you have to allow that trade to last for minimum 3 candles. So any time frame you are looking at in predicting the market, any chart you are looking at will determine how long the trade should last. Okay, if you're looking at a 1-minute chart, the trade is going to be 3 minutes. If you get your confirmation from 5-minute chart, the trade is going to last for 15 minutes. Oh, I want to say congratulations to you for making it up to this moment. So if you see this, that means you are one of the lucky winners who have seen this video to the point that you have qualified for this one-time offer. Now, if you want to have access to all the resources and also all the trainings, both the ones that we did in our previous masterclass, you want to have access to everything, all you need to do is to click on the link below and pay a token of $100 to have access to all these packages. Now, if you want to get these results that you are seeing on your screen, you do not want to miss this offer. All you need to do is to click on the link below and pay $100 to the link, and you would be able to have access to not just the 3-month mentorship, you also have a one-on-one training with me for 7 days before you will be able to have access to the mentorship session. Now, just imagine trading with me and also learning how to do all the tricks that you've seen on my YouTube channel. I'm looking forward to working with you. All you need to do, click on the link below. Time is running out. It's just gonna be for 7 days, guys. 7 days. After the next 7 days, we're gonna take the price back to 1,500. So take this offer because it's a one-time offer you do not want to miss. Click on the link to go get ready start. Thank you. So with this, you now know that, okay, this is what price is going to do. As long as you've gotten your entry, you also know how long your trade is going to last, which is now 3 minutes or 3 candles. Okay, allow your trade to last for 3 candles. Now, I want to talk about the power of compounding right now. Now, when you are trading in the binary forex market, the reason why most people are frustrated is because they really do not know the numbers. Anytime you want to start investing or you want to trade in the binary forex market, you need to also consider compounding your account. because you want to develop an habit. Now, the power of compounding is that you will be able to develop an habit. So now, let's say you have a $250 account. Yeah, you have a $250 account. $250 account with 5% daily growth for 100 business days. How much investment is it going to give to you? Now, if you go to compounddaily.org and do this, you're going to get a whooping sum of $32,876. Now, for 100 days, starting from $250, you make $32,000 if you compound. So, for me, I would advise you to focus on compounding your account rather than just trading on a stretch, because you want to develop an habit of how to do what is it that you're doing. So if you can be able to compound your account, you can be able to grow that habit of trading. Take it step by step. Sometimes you think 5% is really small, but when you compound it, it's really going to make sense at the end of the 100 days. Now, when you go to Compound Daily, you can, any amount of money you want to start with, you can put it right here. It's going to give you a project, what you should be projecting for, and it's going to give you the dates, and you can send this to your email and have a copy of it while you are planning on trading. Okay, now this being said, now this is the link. You want to click on it to open a broker account. Open a broker account. Let's get you started and prepare you for the advanced session where you will be able to go in depth on how or why price action is very important in trading, and also how to really trade with the fundamental analysis. Okay, now that being said, I'll be signing out right now.